Welcome to this explainer. Okay, today we are unpacking a massive, really urgent shift happening right now in the battery energy storage systems, or BESS sector. If you're involved in energy markets, you already know things move fast. But right now, the ground beneath utility-scale storage is shifting in ways that demand immediate attention and, honestly, a totally new strategy.
So let's dive right into this. Is your BESS business case built on a rapidly eroding foundation? For a lot of asset managers and project developers watching, the uncomfortable answer might actually be yes. The stakes in today's energy transition are incredibly high, meaning that what worked flawlessly just, few years ago, well, it could absolutely sink a portfolio today.
Here's our roadmap for today. First up, the PV expansion effect. Second, the death of pure arbitrage. Third, pivoting to multi-market optimization. Fourth, 3 revenue stacking strategies. And finally, securing long-term bankability. Let's get going.
All right, Section 1, the PV expansion effect, how solar is rewriting the rules.
And this brilliantly illustrates the shift we're seeing. Just a few years ago, traditional spot markets were characterized by volatile, highly profitable midday price spikes. It was practically a money printer. But today, current spot markets feature completely flattened midday spreads and severely compressed margins. Actually, in several major markets, we've seen midday prices literally drop below zero while the sun is shining. Because solar panels are just flooding the grid with cheap energy, those reliable midday price spikes we used to count on, they are simply vanishing.
So what does this all mean? Well, it means the massive influx of utility-scale PV deployment is fundamentally rewriting the economics of battery energy storage. We're talking about a sheer scale of solar expansion here that has a direct, unavoidable impact on the economic fundamentals of the grid. You simply cannot ignore this reality if you're operating utility-scale storage right now.
Moving on to Section 2, the death of pure arbitrage, why old models are failing.
Listen to this vital warning straight from our source material. If an asset developer is still building their BESS business case primarily on pure energy arbitrage, they are anchoring their portfolio to a rapidly eroding foundation. Wow, that is a powerful, urgent statement. Relying on just buying low and selling high based on predictable daily spikes, it's just no longer a sustainable strategy. The foundation you built your models on is literally washing away.
So, why exactly is the pure energy arbitrage model failing? It really comes down to 3 distinct but very interconnected reasons. 1, those midday spot market price spikes are flattening, as we just saw with the whole solar boom. 2, margins are compressing across the board, which makes it drastically harder to squeeze out a profit. And 3, this combination creates an extreme vulnerability to pure wholesale price volatility. Think about it. If your entire business model depends on wild price swings that are suddenly just smoothing out, well, your primary revenue source dries up entirely. No way around it.
Which brings us to Section 3, pivoting to multi-market optimization, the new safe haven.
Now, what's really interesting about this concept is a massive piece of the solution, AFRR, or Automatic Frequency Restoration Reserve. This is an advanced ancillary service that's absolutely essential for stabilizing the grid. But more importantly for you asset managers out there, it's a critical tool to unlock entirely new revenue streams for battery storage. You have to start thinking beyond just storing and discharging energy and really start providing grid stability services.
Another absolutely critical piece of the puzzle is capacity-based remuneration. Basically, these are emerging frameworks that compensate storage assets simply for having available capacity. And guys, this is a real game changer because it completely decouples your cash flow from the chaos of wholesale price volatility. You literally get paid for just being ready and available to help the grid. It provides a much more stable alternative foundation for your business case.
Okay, let's jump to Section 4, 3 revenue stacking strategies, the action plan.
Let's move on and see exactly how this builds into a cohesive strategy. Step 1, pivot to multi-market optimization. You just can't put all your eggs in one wholesale basket anymore, right? Step 2, integrate advanced ancillary services like AFRR. And Step 3, leverage emerging capacity-based remuneration models. By purposefully stacking these 3 strategies together, developers can rebuild a totally robust and reliable business case.
So when you stack these approaches, they interact to provide some really vital market benefits. First, multi-market optimization diversifies your income against that brutal spot market compression we discussed earlier. Then, advanced ancillary services, like AFRR. Well, they not only support grid stability, but they tap into entirely new, really lucrative markets. Finally, capacity-based remuneration insulates your portfolio from all that wholesale volatility. When you stack the whole shebang together, you create a diversified, highly resilient revenue stream that can comfortably withstand the solar expansion effect.
And that brings us to our final part, Section 5, securing long-term bankability, protecting your portfolio. So, the crucial point is this. If you take just one thing away from this explainer today, let it be that you absolutely must decouple cash flow from pure wholesale price volatility. Separating your project's revenue from the unpredictable, compressing swings of the spot markets is the ultimate key to securing long-term bankability. You have to purposefully build a buffer between your bottom line and the wholesale market.
I want to leave you with this final, lingering question straight from our source material. For the asset managers and project developers out there, how are you adjusting your revenue stacking strategies to insulate your portfolios against those compressing midday spreads? Look, the market has undeniably changed. The foundation has completely shifted. It's time to evaluate your strategies, leave pure arbitrage in the past, and really pivot toward the future of battery energy storage. Thank you so much for joining me for this explainer, and I really hope this helps you build a much more bankable future.